All right, well, as we get ready to set up the trading day for this final day of the first quarter of 2025, I do want to bring in a guest who joins me all the way from Vienna, Austria. Octavio Marenzi, he's a founder and CEO of Opimas. Joins me now. Octavio, thank you so much for joining us, especially with the time difference here. And we do see the market showing some trepidation at the open. How would you describe the first quarter of 2025?
Well, it hasn't been a spectacular quarter, has it? I mean, it's been down basically right across the board. So what is going on here? I think all eyes are really on tariffs right now. So that's really the only thing that people are thinking about in terms of where the market's going to go and which industries are going to be impacted. What is Donald Trump going to do on April 2nd when he announces his Great Liberation Day, and how's that going to unfold? I fear that people are pricing in a certain level of tariffs into stocks right now. So we see that. But I think more than anything, we've got uncertainty. But I don't expect that uncertainty to be resolved this week. I think Trump is going to carry on negotiating hard, and things are going to be jerked back and forth as a result of that. So I don't necessarily expect to see clarity. I think we'll see an opening gambit more than anything else April 2nd, and then a long set of negotiations as things unfold.
So how should our viewers, Octavio, tuning into our program, navigate this level of uncertainty in the market?
Well, I think a very safe thing to do would be basically park some money on the side and say, until things become clear, there's greater clarity in terms of where things go. Cash is a really good place to be. Gold is looking like a really great investment, and it's really the only thing that's been working for a while now. So that is looking like a really great place to be. But I think we see these kinds of stocks and sectors do very well when there's this level of uncertainty. So that's what we're confronted with. I will say that if you look at the economy overall, it's still looking pretty healthy. I mean, you talked about the jobs report coming out. We've got unemployment hovering above 4%. That's likely to inch up very slightly, but still look fairly strong. So we're looking at good job numbers. I think the overall growth of the economy is still looking pretty good. So we saw a slight revision upwards to the fourth quarter GDP numbers come out a couple of days ago. So that still looks good. So those signs are encouraging. The real question is, what does the Fed now turn around and do? What will it do? And I think they're going to have their hand forced. They're going to have to increase interest rates further to try and tame inflation that has on one hand been caused by monetary policy, but now is also going to be stoked by tariff policy. And that's going to force them. They're going to have to increase rates, and that's going to be bad for the market.
Yes, and that certainly has been a change in rhetoric, Octavio, that we've been experiencing, including from the markets guests who joined me on Friday, as well as each day does bring new important data here on the market front and on the inflation front. So walk us through what goes into these higher inflation expectations. There are concerns among consumers that the jobs market is going to weaken. Is it solely tariffs that are pushing the pace of price gains higher?
I think no, not at all. I think what we've seen is basically the Fed has pursued a very loose monetary policy for a really extended period of time. And they've drained some of that money out. So they have increased interest rates quite significantly. But there's still a huge amount of liquidity out there. Banks are still sitting on very large reserves that they could then bring to measure and use and actually lend out and drive inflation further. So there's still a potential there for a sort of a monetary-led inflation as a result of the Fed's very loose policy that went on for an extremely long period of time. I mean, not as long as it did in Europe or in Japan, but nevertheless, the Fed had a very loose policy for a very long period of time. And that money is still out there. That's still sitting on bank balance sheets, and it's still sitting on companies' balance sheets and books. So that cash can still be put to use and drive inflation higher. But then we've got inflation driven by the tariffs as well. So is that the only thing that's driving higher job losses? No, I think people are concerned about inflation first and foremost, more than job losses overall. That's really what's concerning people. Now, I don't know if I would have 100% confidence in the consumer's ability to forecast inflation that far forward. We've seen professional economists have a very hard time with that. I'm not sure I believe in the wisdom of crowds in this particular case, but we'll see how it unfolds.
So we do see, according to a CNBC survey here, Octavio, that first quarter GDP growth is expected to be just 0.3%. Again, that is according to survey data. But since you're discussing how the consumer feels in this moment of time, do you think that a 0.3% gain in first quarter GDP is realistic?
I think it's entirely realistic. I wouldn't be surprised for it to come a bit higher than that overall. But I think that is certainly weighing on the consumer overall. You know, this idea we're seeing a slowing economy, we're seeing prices increase. That is going to put people in not a very positive frame of mind overall in terms of their spending habits.
And my final question to you, as you're joining from Vienna, Austria, is what does this mean for the global investing landscape? We had seen Europe underperform for quite a long time, but of late it actually has been performing quite well, even among President Donald Trump's America First agenda.
Well, certainly if you look at the performance of the European and the Asian stock markets over the course of the past few days, they've been quite negative overall. There are, of course, a lot of European companies and Japanese companies that are going to be hit very, very hard by tariffs. Bear in mind, Europe in general and Japan in particular are more export focused and more oriented than the US is. So they're going to be hit harder by tariffs being ratcheted up. So that really is weighing on the European markets overall. I think on the positive side, in terms of European markets, the European Central Bank has basically been a bit more accommodating in terms of interest rates and has lowered interest rates a couple of times now and seems to be set to continue that. So that's driving markets in Europe. I think overall is sort of an interest rate-led increase over there, but pulled back now by this fear of tariffs coming up with the US.
Octavio Marenzi, founder and CEO of Opimas, joining us from Vienna, Austria. Octavio, thank you.
Thank you.